Good evening to everyone. I hope I can be heard. Let me warmly welcome all of you all for the first quarter financial update of National Bank. So as always, I'll take 10 minutes and take you all through the presentation, and thereafter we'll open it up for any questions. So to start with, on the overall numbers, you will see that interest income for the first quarter, we actually saw a 13% drop in interest income, mainly as a result of AWPLR coming down by around 400 basis points from first quarter of 2020 compared to coming down from first quarter of 2020. So interest expenses also, we have seen a drop of 17%, and here, despite a significant growth in the deposit base, we have seen the interest costs coming down from 16.5 billion down to 13.6 billion. So overall, net, we have seen NII showing a slight drop of 8.1%, down from 13.3 billion to 12.2 billion in first quarter 2021. So in the below graphs, you will see that the interest rate drop is seen. It actually peaked in 2019, and from there on, we have seen interest rates coming down. But maybe in the last 3 to 6 months, we have seen interest rates more or less stabilizing at these levels, and maybe in the recent past, even treasury bills, we have seen a slight uptick as well. So overall, on the NIMs, we have seen NIMs coming down fairly drastically at a group level. In first quarter 2020, we saw a NIM of around 4.9, which now has come down to about 3.8. That's over 100 basis points drop. But now we see more or less NIMs stabilizing at these levels, and we probably might see these NIMs reversing and start going up, especially if AWPLR and rates start to go up. Though there was a drop in NIMs, especially as a result of interest rates, AWPLR coming down by about 400 basis points, the improvement in the CASA base, which was the CASA ratio, which was around 35%, going up to over 40%, has actually cushioned some of this drop in the NIMs. So overall, we have seen CASA ratio at around 40% and year-on-year growth of around 30% from first quarter of 2020. Going into the fee income and non-interest income lines, you see that we have seen a growth in fee income compared to first quarter 2020, and first quarter 2020 was to a large extent was a normal period, because the COVID actually started impacting the economy towards mid-March. So 2.5 months in 2020, we probably had a fairly normal operating environment. So compared to that, growing fees by about 14.5% in first quarter 2021 is a fairly good achievement. And in addition to that, we are also seeing a substantial increase in exchange income, and that again as a result of the depreciation of the rupee in the first quarter of 2020 compared to first quarter of 2021 compared to first quarter of 2020. Then we also see the insurance company also has done fairly well. So the insurance premiums have also gone up by about 25% in 2021 compared to 2020. And here, if you look at the composition, again, this small green line here, which is 5.5% contribution to overall non-funded income compared to just 2.2% in 2020. that increase is actually coming from the dividend income that we have earned. Now in 2020, most of the dividend income came in the second quarter because of the lockdown that happened and most companies couldn't have their AGMs. But this year, we have seen some of the dividends coming in the first quarter from our investment. So that's the reason for that difference. So going into impairment overall, compared to the first quarter, we have seen a drop in impairment. Again, the main reason for the drop in impairment is because of a lower impairment made on account of our investments in SLDBs and SLSBs. In the first quarter of 2020, there was actually a downgrade of the sovereign. It happened just after the first quarter, I think in April 2020. As a result, we actually made a 700 million impairment on account of SLSBs and SLDBs in first quarter of 2020. And in 2021, we have not had to make such an impairment on SLSB. So that has been one of the major contributions for the overall drop. In addition to that, we have made a fairly substantial amount of impairments during 2020, and given that some of these loans have now started moving out of moratoriums and started repayment and NPAs coming down, the requirement for further increase in impairment was probably lesser than what we were facing in the first quarter of 2020. So overall, we see a drop in the impairment from 4.7 billion down to a 2.7 billion. So advances have, if you look at from December 2020 to March, we have had a slight drop in advances growth, about 0.7% drop. And this is mainly coming from our corporate sector, where some of the money market advances, which were at fairly thin pricing, has moved out. But we have seen growth happening in our retail book and our SME book during the first quarter. So going into the balance sheet, the capital and liquidity ratios, we continue to remain fairly well capitalized compared to the minimum capital requirements. Our total capital adequacy at 17.8 and Tier 1 at 14.8. Liquidity ratios are also significantly higher than the minimum requirements, almost double, which is at about 40% compared to a minimum requirement of 20%. And you see the loan to deposit ratio has also come down from a high 90s to around 77% in March 2021. In terms of cost, well, personnel cost, we have seen a slight increase, and this also is to a bit distorted because in 2020 first quarter we had reversed over provision on bonuses, which was probably not there in 2021. So that kind of exaggerates this growth, but other than that, we have managed the overall personnel expenses fairly well. The main driver in cost has been coming from insurance costs, because we have seen on that side there has been increase in premiums from insurance. But in addition to that, on the cost as well, we have seen increase where compared to the first quarter 2020, there's been an increase in claims, and that has also has had an impact on overall cost escalation. Other expenses, we have actually seen a drop. These mainly coming from lower payments to Visa Master on account of less foreign card transactions, lower amount in terms of IT maintenance costs, lower expenses made on advertising. So overall, total expenses at a bank level remains flat or slightly lower than 2020, but at a group level, it's a 7% increase, again, mainly driven by this insurance cost on claims. So at a bank level, cost to income ratio has come down from 39.7% down to 38%, but there is a slight increase in cost to income ratio at a group level, again driven by the insurance cost. Taxation has come down. We all know that the 24% tax rate was finally implemented, and the, the earlier 28% tax rate has now been readjusted to 24%, and as a result, we see that the effective tax rate of the bank, which was around 38% in first quarter 2020, has come down to 31%, and at a group level down from about 39% to 33%. So overall, total group PAT is at 4.8 billion, which is a 57% increase compared to last year. So on the ROA and ROE, you see that ROA has improved to 1.44 at a bank level from 0.93, and ROE going up close to 14% from 8% last year. So drivers have been, again, there is a drop, of course, on NII and NIMs, which I mentioned. There is improvement coming from other income to average assets. This is mainly coming from exchange income. There's a significant positive impact coming from lower impairment, and also operating cost and taxation have also helped in driving the ROA numbers, and better leverage again has helped the ROE numbers to go up. Similar trend at a group level as well. Group ROE at 12.13 compared to 8.29 last year, and group ROA at almost 1.4 compared to 1.09 in the previous year. So with that, let me conclude my presentation, and let me now take any questions that you might have.
Hi Rajiv, this is Ruchi from Asia Fund Capital. Can I ask a few questions, please?
Yes, please go ahead.
Hi, thanks for your presentation. So just a couple of questions. One is on the loans under moratorium. What were they as a percent of your book in the first quarter of this year compared to first quarter of last year when the pandemic just began? And the second part of that question is, now that you're seeing these third wave of cases in Sri Lanka with some kind of small lockdowns and movement being restricted, are you expecting an increase in the moratorium again?
So, Ruchir, first quarter, we actually didn't have any moratorium last year because it was March that we went to lockdown. And I think when we finally finalized the moratorium, it was about May 2020. But in May 2020, we had a moratorium base of about 40%. So from our overall book, around 40% of our loans were under moratorium. Then in September, when some of those moratoriums came out, and that 40% came down to around 15% after 30th September 2020. And then after March, where most of these moratoriums were going to go out, except for some of the leisure sector or tourism sector moratoriums, we have seen that the moratorium percentage coming down from about 15% to around 5%. But then, as you mentioned, we are now approaching a second wave, and there is likely that the central bank may want us to consider a further round of moratoriums, especially if the lockdowns are going to increase, and that we may have to look at that. But at the moment, there is no specific direction that has come out, but there are discussions happening. So we will need to wait and see how that would play out.
Thanks. So are you seeing any pressure from your clients in terms of repayments or collection at this point in time? And you said it's about your moratorium loans about 5% of the book. I mean, in your estimate or rough estimate, how much could that go to, say, in the next 3 or 4 months?
So that's difficult to say, Ruchir. Again, that will depend on the extent to which this lockdown will go, And also it'll depend on the severity of the COVID situation. On the other hand, we also see that unlike in the first couple of waves, we now see the vaccines coming in and the vaccination program going on. So if we can get majority of the people vaccinated, that would to a great extent help contain this wave. So again, the amount of moratorium will depend on how prolonged this is going to be and whether we'll go into a full lockdown. For the moment, I think we haven't seen a huge issue in terms of payments, and that's probably why we have seen that NPAs also remain at a fairly low level, and we probably have one of the lowest NPAs compared to the industry at 4.2%. And uh, again, we'll have to wait and see. Going back to the second wave, now the first wave, when we had to have a 40% of our loan book under moratorium, the whole country was under lockdown for about almost 2 months. But the second wave didn't have such a huge impact because there was isolated areas that went into lockdown, but the whole country was not under lockdown, and commercial operations did happen. So even this lockdown, the third wave, though we see that the cases are rising, so far the government has shown a lot of resistance for a total lockdown. So if that doesn't happen and still the normal commercial operations do continue, then it might not be as high, the requirement for moratoriums as we have seen in the under the first wave.
Okay, thank you. Thanks.
Hi, Rajiv. It's Nick Paget with Funtora. Can you hear me okay?
Yes, Nick, go ahead.
Okay. So first, let me just continue with the prior question. For the clients that were on moratorium, but no longer are, what has the payment experience been with them, once they came off moratorium? Are they similar to the book that never was on moratorium, or do you notice some later payments from them? Maybe they're still stressed relative to the book that was never under moratorium.
So Nick, for the first ones that went out of moratorium in September, we have not seen a significant impact. There's a right. So on the first moratorium, after the first moratorium, we have not seen an impact, but payments have continued. You have not seen PAs increase, and actually MPAs have come down from third, which was at 2020, which was at 6.5%, come down to about 2.2%. But the moratorium that ended in March 31st, then we need to, it's too early actually for us to assess how that would play out. And those customers might now be the most risk because of the third. But that payment experience, we'll have to wait and see how it comes.
Okay, it cut out a little bit. I can hear you better now. I put my headphones on. Did you say, I heard you say it's too early to tell with the most recent ones, and with the earlier ones, I think perhaps you gave a number, but I couldn't hear it.
Yeah, so what I said, Nick, was that from September.
Nick, you need to mute.
Hello. Yeah. So from September, you have seen NPAs coming down from 6.5% down to 4.2% as of March, which means that the 15% that came out of moratorium in September have actually been paying well, and otherwise those would have now by now gone into NPA. So why you had not seen a rise in NPA is because those 15% loan book that came out of moratorium in September has been making their commitments. And what as you rightly said, after March, it's a bit too early now to actually say what will happen on the remaining 10% that came out of the moratorium. And those people might now be a bit stressed with this new wave, and we might have to accommodate some of them into another moratorium if these lockdowns continue for much longer.
Okay, I'm clear on that, and apologies for the technical issues. So then if we look at cost of risk for this year, I know it's a moving target and probably hard to say, but what would you what do you think is sort of cost of risk for either for the full year or the remaining 9 months?
So it is difficult, Nick, to really at this point not knowing the extent to which this third wave will have an impact on the economy and on the commercial operations of customers to really put a figure down at this point in time. But of course, going by what you have seen in our credit, the impairments that we have made in the first quarter, you know that our expectations are that impairments and the credit, the cost of risk would be lower this year compared to what we saw last year. So let's I would be targeting something around 1% for a wanting of a number, but it's very difficult to give a number right now, Vani.
Okay, and then one final thing, could you just give us your outlook now on the government debt picture, and will the allocation of additional SDRs that the IMF has proposed, I read one analysis that said Sri Lanka could get about 1.4 billion extra reserves. I'm not sure if that's definite or just a possibility. So any comments you've got on how that might help the overall picture, I'd be interested in your perspective. Thank you.
Yeah, so Nick, on the government side, they continue to be fairly reluctant to go into an IMF program. Well, in my view, going into an IMF program would help more than, I think the money would definitely help, but more than the money, I guess it's the signaling effect and the confidence that it will bring so that you'll have other investors being more confident to come in. So that's probably the biggest advantage going into an IMF program. But for the moment, what we have seen is that the government has been reluctant because of various conditions and various conditions that come with an IMF facility. So for the moment, they have stick with some of the other bilateral arrangements that they have to continue with the improvement of reserves. So they have probably done about 2 billion or close to 2 billion transactions or arrangements in the last couple of months to improve the reserves. It's very difficult to say right now whether government will actually go into an IMF, but whatever that we have heard is that they'll continue to resist, and that's what it seems at the moment.
This SDR allocation, do they have to do they get that automatically, or is that something they'd have to be in an IMF supervised program to access those additional SDRs?
So I probably am not totally fully aware on the conditions and what happens. I believe you probably need to go through some kind of program to actually get it, or at least there would be certain conditions coming attached to it. Otherwise, government might have gone and already taken it. But to be honest, I'm not totally aware of all the details attached to it.
Okay, fair enough. That's all from me. Thank you.
Thanks.
Rajiv, it's Asanka from Linear here. Can you hear me?
Yeah, Sanka, go ahead.
Rajiv, in terms of your cost of funding, it has come down quite a bit actually if you look at it over the last 12 months, etc. Is the pricing down of the deposits would it continue for a few more quarters? Can you give some sense as to where are you in terms of rollovers there?
So most of our loans, actually, the repricing loans are already repriced at the current levels, because most of the repricing happens within 1 to 6 months, and most of it are actually the 1 to 3 months bracket. So I would say all the loans that are getting repriced would have got repriced. So, and even in an uptick in interest rates, these assets will quickly get repriced upwards. So that's where I said when interest rates do go up, the margins will also be pulled up together. And most of our government securities are also on the shorter end and not too many in the with long durations. So therefore, wherever interest rates change and starts going up, there'll be a substantial benefit coming through.
So while your loans got priced down pretty fast, you meant to say that deposits will your interest expense rate on your deposits will continue to come down for the next couple of quarters, or
no, I would say most of the deposits have also come down. Probably deposits again have slightly higher duration because some of it are 12 months deposits, so it takes a bit of time to get repriced.
Right.
The bigger impact is actually on the CASA. So you'll have a substantial amount of CASA, which is about 40%, that doesn't get repriced. So when most of your loans get repriced and the rates come down and your CASA remains at the same level, is where your margins get squeezed. But on the uptick also, you actually benefit from that, because only 60% of your deposit base will actually get repriced, and that 40% you will benefit. Of course, there'll be a slight shift from that CASA ratio coming down into FTs, but then even that increase that you get on improving margins on the CASA will definitely help you.
So if the environment turns out to be where the rates remain broadly with where we are today, can we expect the NIMs to remain at these levels in the couple?
Yeah, so that's why I said, Asanka, we would expect then though the NIMs have come down now, it would be stabilizing at these levels until you probably see rates going up again, where it'll kind of take a U shape and start going up. Whether it'll take a V or a U will depend on how long the rates will remain at these levels and how quickly it will change.
Thank you.
Rajiv, this is Naveen from Linear.
Yeah, hi Naveen.
Hi, just a quick one on the credit side. You mentioned that you were seeing a bit of demand from the SMEs and perhaps retail. Can you kind of elaborate a bit more on that and on the SME, where any particular sectors that you're seeing a bit more activity?
So no specific sector. I think across we have probably seen demand, Naveen, in terms of On the personal side, we have probably seen a fairly good demand on housing. And that's something that we have probably seen with lower interest rates. Housing has probably become a bit more affordable than taking a housing loan at 15-16%, now at about 7 to 10%. It kind of have become a bit more affordable, and you're seeing a fairly good demand on the housing side. SMEs, I think it's fairly broad based, and no specific sector that I can pinpoint and say it's only coming from this sector.
So my second question is, with what's been happening on the currency, are you seeing a kind of a migration of customers, say perhaps from the smaller banks to banks like HNB for their trade finance activities? Because I would assume that you all, with remittances, etc., you all have a much better access to foreign currency than some of the smaller banks.
So the currency actually is a concern, and I would say there would be certain migration, especially to banks who have a better volumes of remittances as well as volumes of exports. You will see that some of the importers may look at migrating. So yeah, that would happen.
So my final question is on the case of remittances. What are you seeing? Are we seeing similar levels that we saw second half of last year, or are you seeing remittances easing off?
We still see a fairly good flow in of remittances, Naveen. So I think even if you look at overall the country remittances, you probably see around a 15% increase, even first quarter compared to last year's first quarter. So I think that similar trend is continuing even in the bank side.
Thanks, Rajiv. That's it from me.
Sure. So there's a question, what proportion of loan book do you expect to be in NPLs after the impact of the third wave? Again, very difficult question, similar to looking at how much is going to be under moratorium. We expect to maintain NPAs at the levels that it is there, or rather to bring it down. We probably don't expect too much going into NPA. And we'll be working on that fairly closely. And again, the answer to that will depend on how prolonged this third wave is going to be and how badly it would have an impact on the economy and the businesses. So the second is HNB corporate book has reported a 21 billion contraction in the asset books. What is the reason? So I actually I think I touched on this during my presentation, saying that it's the corporate book that the loan book has come down, and this has been mainly the money market and short-end facilities which were very thinly priced, and we had to let some of these go because some of these corporates were demanding for rates even below the short-end treasury bill bond rates, which probably did not make sense. We are able to put it in treasury bill bonds and get a higher yield. So those we have let go.
Hi Rajiv, I'm Kushan from
Hi.
Lee. Yeah, just a question on the taxes. So I think 1Q21 we have seen that retrospective impact on the lower taxes being introduced that has been taken into account. Can you explain how much of an impact was there coming from the reversal of 2020 taxes versus the increase in the deferred tax assets that has impacted, and how much is the net impact?
So that was about 100 million, I think. So overall, it was about the tax reversal was about 800 and the deferred tax asset reversal was about 700. So net, I would say would be about 100 million plus to the P&L.
Okay, Rajiv. Another follow-up question. So I think, yeah, it was somewhere around 100 to 80 million, but the income tax rate has substantially gone down to around 15% effective tax rate for 1Q21. Was there any other deferred tax or any other one-off taxes that was there as a reversal?
So it's also the if the FCY bonds that are exempted from taxes, that also has a positive impact. Yeah, so that portfolio has also increased significantly during the year. I think if you look at from last year to this year, there is a significant increase in our sovereign exposure. So that also has a positive impact on the tax. In addition to that, the exchange would also have an impact on the overall tax rate, because the exchange gain component is also fairly high.
Okay, thanks, Rajiv.
So there is a question on what is HNB's current lending mix in terms of corporate, retail, SME book. It's around, we still have around 45% in corporate and emerging corporates. We have about 30% in SME, and then the remaining would be the retail and the small micro book. So that has not changed significantly. If at all, corporate would have slightly come down, but not a significant movement from where it was as of last year. The NPL breakup, I probably don't have it right. Okay. No, I don't have the breakup in terms of corporate SME right now. I'll try to see whether I can give it to you before the end of the session. Any other questions? There was a question on exchange rate and how it remains at 200. So I guess there are a lot of restrictions on the overnight positions, and the rates are fairly rigorously monitored by the central bank. So you would probably aware of that. So there's hardly any speculation that is possible and keep any open positions, and most of the buy-in on the exchange rate, it would be to support importers. So therefore, that's probably the reason why you will see that there's no significant fluctuation on the exchange rate. There is a question on the balance held with central bank has increased in 2021 first Q. Any specific reasons? This is more or less in line with the increase in the balance sheet growth. So you see about 100 billion increase in the deposit base. So in line with that, your SRR requirement would also go up, and that would be the reason.
Rajiv, it's Nick Paget again. Could I just ask a follow-up on the exchange rate question?
Yeah.
So if I look at a chart of the currency, from last year, there's a, pretty steady devaluation from, it began 2020 around the 185 level and, really devalued pretty steadily through mid-April when it got to around 201. I'm looking at Bloomberg. Mm-hmm. And then there was a sharp appreciation almost to 190, although I think that maybe isn't very representative of rates people were actually getting. And, now it's settled in, at least on Bloomberg, around 197. So are the measures you spoke of, were those introduced around the mid-April timeframe? I guess we're just puzzled by this, appreciation that's partially but not completely reversed over the past month, and what's changed that's ended the steady deval we saw for nearly 16 months previously, and will that steady deval come back and become the norm again?
So the devalue also happened, Nick, as a result of the downgrades that happened on the sovereign and the change in the I would say the perception, the investor, the risk appetite, all that changed, and hence the investments didn't flow in, and all that had an impact on that gradual devaluation to happen. So, of course, the appreciation from 200 to 190 probably was partly not warranted and might have been due to some short-term adjustments that would have been done in terms of selling dollars in the market and so on and so forth. But there again, because of the import restrictions that are there, because of the less amount of spending now that would happen due to various lockdowns, and as a result of all that, the demand for dollars would also slightly come down, in addition to various restrictions that have been brought in. The open positions of the banks have been cut, and there is close monitoring to ensure that whatever the purchases are on account of the import bill payments and so on and so forth. But even if you look at, let's say, the first quarter of 2020, you saw there was a huge depreciation that happened, and that's again driven by, to a great extent, perception and the expected issues coming due to the downgrade and then the impact of COVID. But thereafter, with the imports being restricted, you saw the exchange rate again coming down and stabilizing at around 185. So those spikes and jumps that happen time to time, though there is some fundamental reason that is driving, is also exaggerated by some of the perceptions, anticipations, expectations, and trading calls.
I know it's almost impossible to answer, but could you give us your best guess on where the currency might be, say, at year end?
I think currency is probably the most difficult variable at this point to forecast out of all the variables that we look at, Nick, because there's so much of factors that are working, and as I mentioned, even speculation and all that coming in. It will again depend on how successful the government is with their bilateral discussions, whether they will go back to IMF and draw down on these lines that are available to them. Will they be able to get short-term lines to improve the current reserve position, which is around, I think, 3 months with the swap that was done, maybe going up to about 4 months of imports. So all that will depend. I think in the medium term, it will also depend on the investments that will flow into the port city project. That will also play a major role in the medium term to stabilize and probably change the game and probably stabilize and to see the balance of payments changing with attracting more FDIs and more investments into the country. But in the short term, it'll hinge a lot in the next 12 months on how successful the government is going to be in these discussions and the bilateral discussions they have, as well as the appetite to go with IMF. So to give a number there is almost impossible, Nick. I won't even try to do that.
All right, thank you.
So I think on the NPA segment wise, out of the total NPAs, around 38% of NPAs come from corporate and emerging corporates, around 39% from SME, 18% from retail, and about 5% from microfinance. So there's a question on HNB Finance. HNB Finance was doing fairly well. They actually made losses in let's say soon after the first lockdown, because they were unable to disperse loans. They were unable to go and collect because of lockdowns and isolation. And they actually were flushed with liquidity, which they were not able to disperse, had to invest it at government securities at about 3, 4, 5% loss to the bottom line. So all that had an impact on them. But since January, they were able to reverse some of these. They were able to bring down NPAs by almost, I would say, about 10 percentage points. They were also turned around and started making profits from January. But unfortunately, now the third wave has also impacted. So with the lockdowns again, they will struggle to go in, collect and do the disbursements like they were doing in the first 3 months. But still things are okay. They've kind of managing the NPAs at the levels they brought it down to, and overall profitability remains. Hopefully, if the lockdowns don't prolong for too long, I think they are going to be okay. So what is HNB's exposure to HNBF? I believe you're asking what is our investment in HNB Finance? I believe that's a question. We have a 600 million investment that we have done to acquire 51% voting rights in the company. I think the investment value of that currently, we have it, of course, in our bank's balance sheet still at the investment cost. Of course, it is consolidated when it comes to group accounts. But if you really look at the market value, I'm sure it's about 3 to 4 billion rupees worth. Okay, exposure to non-banking financial institutions through loans. Again, I don't think I have that specific figure right now with me. I think it could be about maybe about 20-25 billion, but I don't have that figure right now with me. Any last question before we wind up? So if there are no other questions, thank you very much for joining on today's call, and look forward to meeting all of you all on with our second quarter results. Thank you very much. Have a good day and stay safe.